Okay, I think we can start, right?
Yes, Nitin.
Okay, so good evening, everyone, and thanks for joining us on this webinar today. My name is Nitin Shanbag. I head investment products at Motilal Oswal Wealth Management. And this is a very auspicious occasion for us because we are celebrating the century of our flagship research, publication, which is called the Alpha Strategist. And we also have today a panel, a power-packed panel of experts across asset classes to elucidate their views on the same. So while my team and I are responsible on the products desk to bring to you the outlook, the strategy, and the products across various segments, we always look up to and sort of take a lot of inspiration from Mr. Ashish Shanker, who is the architect of the Alpha Strategist and also the head of our wealth management business. So welcome to you, Ashish. A brief introduction to Ashish Shanker. He's been part of the wealth management setup since its inception. He has over 2 decades of experience in financial markets, and he's an alumni of the prestigious Harvard Business School. He chairs our investment committee. He's been responsible for evolving and strengthening our 4C manager selection framework. And he's also been a regular in terms of media interactions as well. I'll now request Ashish to present to you a few thoughts in terms of our journey of this entire Alpha Strategist and some of the key learnings that we have had over the last 8 years. Over to you, Ashish.
Gaurav, can we get the presentation? Yeah, so good evening, everybody. First of all, thank you very much for taking out time and being with us. I hope all of you are staying safe and in your own homes because, the COVID wave is surged with a lot of ferocity. So we need to protect ourselves and our loved ones. Like Nitin said, it's definitely a very, very big milestone for us to complete 100 editions of our flagship research publication, Alpha Strategist. And a lot of the people who are on the panel today have been part of our investment committees at some point in time or the other. Because what we do is, apart from our internal research team, we also invite one external invitee every month to share their views and give us insights on what's happening across the world in terms of asset classes as well as markets. I thought what better way than to set the context first before we dig into the discussion with all the experts in the panel. So what we've done is, since the Alpha Strategist has completed close to 8.5 years, we thought we'll look at asset class behavior through the decade. Okay. So this is the asset class journey. So we have basically Indian equities, large cap, multi cap, mid cap, debt, short term, long term, gold, liquid, Nasdaq, and S&P 500. Of course, if you look at this chart, right, and if you look at all these asset classes from a decadal point of view, Indian equities have not done that great as the last decade, but they've done reasonably well. I mean, if you look at multi cap, right, which is denoted by S&P 500, it's given a healthy double-digit return. Now, if you add, dividends, the returns will be slightly higher. Large cap equity has done close to double-digit, not exactly double-digit, and small cap, has really struggled, especially in the last 3-4 years. But the clear winner has been Nasdaq, which has delivered double-digit returns, high double-digit returns in rupee terms. Even the S&P 500 is not too far behind. That's also done reasonably well. Gold, contrary to, it had a great last year, but if you look at the 10-year returns, gold has really struggled, right? It's closer to 3.5%. Debt, has been a very tumultuous period. Actually, this return of 8.7% in short term and long term really hides the kind of volatility we've seen on the credit side, right? And we've seen a lot of events happening. And recently, over the last 6 months to 12 months, we saw all the central banks acting very aggressively to cut rates, infusing a lot of liquidity, and we've seen rates at all-time lows as we speak. The other big observation is in this financial year, it just looks like Indian equities have turned the corner, right? If you look at the last financial year, Indian equities have clearly outperformed international equities. Of course, this is in rupee terms. And within that, if you see, we've seen small caps do extraordinarily well. I mean, it's gone up almost 125%. And of course, we will explore all of this with the experts who are there on the panel. Going ahead in in equity markets, this decade, this return masks the kind of volatility we've seen. I mean, we've seen a new government come to power, right, which is now in the second term. We saw a big event called demonetization, where most of the notes were changed in the economy. We saw the introduction of long-term capital gains tax on equities and multiple other events like the corporate tax cut. We saw the default of one of our largest financial institutions, ILFS. And to top it all, after the sharp correction last year, when due to the onset of the pandemic, we've seen an equally sharp pullback. And I don't think any of us would have imagined last year, same time, that this is going to be the outcome in March 2021. So it's been a phenomenal decade, especially a phenomenal last 5 years. But I believe that all of us are looking to the next decade with a lot of optimism going into the next decade. And that is going to be one of our discussion topics. Many reforms and policy changes have been enacted, right from the production-linked incentives which were rolled out, the IBC Act, which made it faster for banks to recognize NPAs, resolve NPAs. RERA, we're going to be talking about the real estate sector, which was a big development, and a lot of small, medium-sized developers have struggled or shut down. We've seen a massive cleanup of this sector, actually. Again, this is one sector which I think we are coming out of this decade with some bit of optimism, and we'll get to know more from our expert on the panel. We saw the implementation of one tax across the country, the GST, Goods and Services Tax. And to top it all, we saw the corporate tax being lowered to 22% versus 30%. So, I mean, rarely, have we seen such, big changes sweeping our economy in such a small span of time. So what does it mean for different asset classes, going into the next decade? Will be interesting to discuss. The other thing is, when I talk about equities, the last decade has been a very tepid decade for corporate earnings growth. If you look at the last decade, we've seen very low single-digit kind of corporate profit growth, right? And can you imagine in a pandemic year, we are looking at double-digit profit growth? I mean, in a year where you had 1 quarter of lockdown, right? The June quarter, where many companies, many operations were virtually shut. In this kind of a year, we are going to see corporate profits grow 17 to 18%. Again, this is, a very refreshing change from the last decade. And we are also looking at it very optimistically from the next 3 to 5 years. At least most analysts are projecting a fairly sharp earnings growth over the next 3 to 5 years, led by many factors, and a lot of them will be quite interesting to dig deeper into. Corporate profits to GDP, as a result, this decade collapsed to close to 2.1%. And if this optimism plays out, then we do believe that we could see a growth in corporate profits to GDP as we saw in the period 2002 to 2008, which could mean a fairly good period for Indian equities. Now, we also saw the NPA cycle peaking out, around 2016-17, where RBI pressed the pedal and pushed banks to recognize bad loans. They tightened the framework around recognition of bad loans, and virtually 12% of assets were restructured or declared NPA, and banks took aggressive provisioning. And as we speak, the numbers have come off, and a lot of corporates have deleveraged. Similarly, banks have capitalized themselves. Even during the pandemic, a lot of the private banks capitalized themselves very aggressively. So it looks like banks are also very well positioned going into the next decade to fund the next cycle of growth. Quickly, a look at fixed income again. Today we saw the 10-year yields again dropping to close to 6% as RBI announced 1 lakh crore buyback program. But this decade has been anything but calm. I mean, we've seen massive volatility through this decade, and we are probably at the lowest level when we talk about the 10-year yield. And I think the last time we saw a sharp dip in 10-year was around 2003, 2002, 2003, where we saw the 10-year closer to 5%. And we are again starting this decade at very low interest rates. But more importantly, the short-term rates have really collapsed, right? And the yield curve is very, very steep. Now, what does it mean for fixed income investors will also be interesting to understand. RBI has basically followed the cue of most large central banks globally, including the Fed, and they have also increased the size of their balance sheet, and they've put in a lot of liquidity, and they have aggressively reduced policy rates, which has led to this yield reduction. As I said, the yield curve is extremely steep. The current yield curve here is the yellow line. I mean, if you look at the GSEC yield curve, this is the 1-year yield. And if you go to 10 years, it's a very steep yield curve. Similarly, if you take the AAA bond yield curve, again, the 1-year yield is closer to 4%. And, as you go closer to 3 to 5 years, which is where most corporates borrow, it's closer to 6.5%. So again, very steep yield curve on the corporate bonds as well as government securities. Should be interesting to see how it will play out. Let me move on to another asset class which is of great interest in India. Last year was very good for gold, but if you see the 10-year returns has not been that great for gold. So as an asset class, this asset class has clearly underperformed, has not had a great time. But going into the next decade with the kind of liquidity we are seeing globally, with the kind of expansionary balance sheet that we are seeing from most governments, it'll be interesting to see if gold should be an asset class that you should own in your portfolio. Lastly, but not the least, Indian residential real estate has also gone through a very, very tumultuous period. You've seen, sales dropping very sharply. So have the new launches. I mean, 2010 to 12 was a great time for Indian residential real estate. After that, we've seen the sales velocity drop as well as the new launches drop. But more importantly, I think the last quarter has seen some green shoots where we've seen a lot of inquiries, we've seen sales picking up, and there are a lot of other drivers which also seem to have come together for Indian residential real estate. So with Indian equities, could this decade also belong to Indian residential real estate will be interesting to understand. Now, some of the factors that have come together for Indian real estate are decadal low interest rates. Today, you're getting mortgage loans starting at close to 6.25. Price has stagnated for the last 5 years. So inflation adjusted, I remember reading somewhere that affordability in Indian residential real estate is close to 2002, 2003. And we know anecdotally that many people are looking to buy their own homes or upgrade their houses, especially because they've realized that home is a very important place during the pandemic. The spreads have narrowed between rental yield and interest rates. And, of course, certain, measures by state governments on aggressively reducing stamp duty have also helped a pickup in real estate. So this could be an interesting asset class, and we'll talk more on this to our expert on the panel. And we'll also try and understand the outlook on commercial real estate, because that's a area which is looking pretty interesting, but at the same time has gone through a lot of catharsis over the last 1 year. Now, one very, very interesting development of our studies, during the Alpha Strategist publication over the last 8-9 years has been that you can own a multi-asset class portfolio and still produce a return which is way superior to many individual asset classes. So what we did was we studied the behaviors of various asset classes over 30 years. Indian equities, US equities, cash, debt, and gold. And what we realized that if you hold a simple portfolio of equal weighted portfolio in each of these 5 asset classes and rebalance it every year, you get a return which is as good as most of the aggressive asset classes. So a 30-year return of the portfolio of equal weighted asset class, equal weighted portfolio of different asset classes could have given you a 12% CAGR as opposed to US equities of 13 and Indian equities of 14. More importantly, on a 3-year rolling basis, this portfolio never goes negative, because in years where equity crashes, gold comes to the rescue and acts like an insurance. And even this portfolio delivers double-digit returns almost 62% of the times, as opposed to Indian equities, which delivers double-digit returns on a 3-year rolling basis of 46%. So this has really been a creation of all the additions of alpha strategies. We've created a product out of this and launched it on our platform. And we believe that this could become really a core holding for a lot of our clients. So, I think I've come to the end of, the thoughts that I wanted to share, and I'm really keen to get into the discussion. So, Nitin, over to you. We can start the discussion with the panel experts.
Sure. Thank you so much, Ashish. And, it's my privilege now to really introduce the panel that we have today. And as Ashish mentioned, I'd just like to reiterate that it's been a pleasure to host them at various points of time at our investment committee. So first up, Mr. Nilesh Shah, Managing Director at Kotak Mahindra Asset Management. Nilesh has been part of the team that has received the Best Fund House Award across all the 3 decades and across all the AMCs that he has worked with, including at Kotak. He's the chairman of AMFI. He's a member of the Mutual Fund Advisory Committee, and he's a part-time member of the Economic Advisory Council to the Prime Minister. Welcome, Nilesh bhai. Warm welcome to you. Mr. Prashant Jain, Executive Director and Chief Investment Officer Equity at HDFC Asset Management. Prashant has over 28 years of experience of investment management. He oversees more than rupees 1,200 billion of equity assets, and he holds the distinction of being the only fund manager in India and one of the few globally to have continuously managed a fund for over 25 years. And that's a pretty stupendous achievement. So welcome to you, Prashant, as well. Mr. R Sivakumar, Head of Fixed Income at Axis Asset Management. Siva has over 2 decades of experience within the Indian asset management industry. He was part of the startup team at Axis, joining in August 2009. And in 2010, he assumed the responsibility of Head of Fixed Income, to which extent he oversees the investment strategy, performance, and risk management across all the fixed income investments at Axis Mutual Fund. So welcome to you, Siva, as well. And finally, we have Mr. Sharad Mittal, Chief Executive Officer at Motilal Oswal Real Estate. Sharad is a veteran in real estate investing with over 2 decades of experience, and he's been instrumental in scaling up the real estate business at the Motilal Oswal Group to now over 4,500 crores. And under his leadership, the real estate division is the most active and one of the largest RE platforms, with a great track record of fundraising, investing, and exits. Warm welcome to you, Sharad, as well.
Thank you.
So now let me hand it over to Ashish for the panel discussion. And for the benefit of the audience, once we are through with the panel discussion, then we will move on to any questions that you may have for us. So over to you, Ashish.
Thanks, Nitin. So first, let me go to Nilesh bhai. Nilesh bhai, the last decade has truly been interesting. But I think the last 18 months, like they say, sometimes, you see decades in a few months. It's really been interesting to say the least, but at the same time, it's been quite stressful as well with all the events that have unfolded around us. Now, it's been a year and we are back in our homes. So how do you think about markets currently? I mean, given the global context that, we've seen a year where central banks have put in a lot of liquidity, markets have rebounded, we are at all-time highs. and now there is a fiscal stimulus being rolled out in the US. How should an investor view this investing framework?
So, Ashish bhai, the last 18 months have taught us the importance of discipline. It is mentioned that Sunil Gavaskar, the legendary opening batsman, after scoring a century, will take a fresh guard. He was restarting his inning without wondering about his previous century. This COVID-19 has also taught fund managers to take a new stance, because what we learned over 15, 20, 30 years, it was tasted in last 18 months. And what we have seen is that people who became fearful when COVID was bringing markets down, they ended up losing probably one of the best opportunity to make money. And people who took the volatility on their stride, they actually benefited. So discipline, discipline, and discipline, that's what is going to help you make money in the market. And your own study about asset allocation kind of exemplifies that. From here onwards, markets have hope as well as fear. The fear is, will rising COVID cases force government to introduce lockdown? And if that happens, what will be impact on economic recovery? Nifty 500 companies for December 2019 quarter reported a profit of about 1,22,000 crore. In June 20 quarter, which was having partial lockdown in that 90-day period, the Nifty 500 companies' profitability came down to about 32,000 crore. So lockdowns have a direct impact on profitability and hence valuation. On the other hand, today market has hope. India has become world's largest vaccinator. We have crossed more than 8 crore people in terms of vaccination. There is hope that vaccination will eventually manage COVID-19 and we will be back to economic recovery. Indian corporates have declared tremendous amount of profitability. When the June number came at 32,000 crore, I mean, people were afraid about corporate profitability. The September quarter was a record quarter, highest ever profit by India Inc. The same Nifty 500 companies delivered 1,76,000 crore of profit, almost 5 times more. Again, skeptics suggested that this is one time. You are not spending money on salaries, you are not spending money on traveling, you are not spending money on entertainment. But December quarter profit was at 2,10,000 crore, again record quarter. Now the hope is that in March 21 quarter, the same trend will continue. In my opinion, this is one of the rare period where the trailing PE and forward PE are at one of the highest divergence. If I look at last 4 quarters run rate, the PE ratio will come at between 40 to 45 times. But if I annualize December quarter and calculate PE, the forward PE comes at about 20 to 23 times. This wide divergence suggests the hope and the fear of market. In my opinion, I will put my money that eventually vaccination will manage COVID-19. We will go back to economic recovery, and that will support corporate profitability. And all the corrections which is coming because of fear in the market will be a good opportunity to invest.
Right. And Nilesh bhai, in terms of reforms, are there any significant reforms that still need to be done, to ensure a more smoother runway going forward?
So reforms are a relative phenomena because we are competing with other countries and they also continue to improve or reform. We have to run faster than them. let me just briefly describe what we have achieved, and then I will come to what we still need to do. So from a high inflation country, we have now become moderate inflation, courtesy inflation targeting by RBI. There are ups and downs, but undoubtedly inflation trajectory has moved from double digit and higher single digit to mid single digit. We are also moving from high fiscal deficit to moderate fiscal deficit, courtesy FRBM. And because of COVID-19, we have reached FRBM levels, but we haven't abandoned them. It will come back. India will come back to fiscally prudent path over a period of time. We have also moved from infrastructure deficit to infrastructure availability. I wouldn't call it infrastructure surplus. The intercity roads are jammed, but outside of city highways are probably as good as one can hope for. Power availability was an issue earlier. Now it's no longer the question. There are supply side, there are bottlenecks on distribution, but generation, by and large, we have achieved our targets. So we are now infrastructure available country. From being physical country, we are now moving into physical and digital. And I will just highlight this. There was one foreign reporter in India who could never see anything good in India during his 5-year tenure. In 5 years, he couldn't find anything good with India. Then he was promoted to France. And the first tweet he made was that in India, I was able to shift money through IMPS, RTGS, and NEFT in an instant. But in France, the goddamn thing takes 3 days. Now, this is our digital power. In US, in Western world, they have created private monopolies. In India, we have created public open welfare schemes. So our digital infrastructure also is a very positive part. In the past, crony capitalism, resource allocation based on private dealings, NPA creating lending, they were part and parcel of our financial system. Now, resource allocation has been on a public auction basis. There's no sweet deal on the side. Bank lending have NPA, but it's not because promoters are faulty or promoters are getting money undeservingly. NPAs are coming because of business cycle. So that also will strengthen our financial system. Now, these are many steps which we have taken, and there will be many more which I have forgotten. But I think what we now need to do in terms of reform is executing government's intended vision that government has no business to be in business. For years, we have suffered because we gave commanding heights to public sector undertakings. PSU employees are one of the best. When they move to private sector, they deliver wonders. PSU assets are also one of the best. When they move to private hands or public-private partnerships, they deliver wonder. But PSUs don't get administrative flexibility or compensation which is comparable to their skill sets, and hence they don't deliver as much as the private sector delivers. Hindustan Zinc was making 100,000 tons and loss-making when it was divested on a public-private partnership basis. Today, 17 years down the line, it makes 1.6 million tons of zinc and contributes roughly between 8,000 to 10,000 crore to the government. Just one company has changed volume by 16 times in 17 years. Imagine if government gets out of business and this assets, this employees comes into the hands of private entrepreneurs, and on public-private partnership basis, we can create many more Axis banks, many more Maruti Suzuki, many more Hindustan Zinc. That will be truly growth supported.
Right. Thanks, Nilesh Bhai. I think that sets a very good macro framework to our discussion. I'd like to ask Prashant. Prashant, you have 2.5 decades experience of managing money, and you've seen various cycles. And I know for a fact that in all our discussions, you've been saying that both investment and consumptions are two sides of the same coin. And you do believe that the investment cycle is on the verge of pickup. So given this macro framework that Nilesh Bhai mentioned, What are the opportunities that you see going forward, and how will you be looking to allocate money? Not in a broad sense. I mean, I know you cannot take stock names, but in a broad sense, what are the opportunities for investors in Indian equities?
Ashish, I think what you presented and what Nilesh covered was actually quite comprehensive. But let me try and add some thoughts around that. One, clearly, the world and India, we are sitting at very low interest rates. And it is anyone's guess over next 1, 3, 5 years where inflation goes and where interest rates go. But I think this low cost of capital makes or cost of capital makes fixed income probably less attractive in return terms, though it has a very important role to play in terms of maintaining safety of invested capital. At the same time, I think it makes equities more attractive. And that is one of the reasons why the markets have bounced back so sharply. Because while profits were disrupted for a quarter or two, but the positive impact on asset values due to lower cost of capital has outweighed that. When it comes to investing across sectors, I think one big thing has changed, and that is partly due to COVID and partly it is due to a coincidence of factors, and that is profit growth is accelerating, as you very nicely put in your chart. 8% profit to GDP in 2008 fell to 2%. Now we are in the path to recovery. I think profit growth is accelerating, driven by the end of the NPA cycle, which Nilesh referred to, number one. Number two, unexpected increase in commodity prices. Number three, some cost savings achieved due to COVID and some of which will become permanent. Number four, deleveraging and lower cost of capital. And I also think a few industry specific factors, certain companies have taken some charges, written off assets, and all that will be missing. I think profit growth seems to be coming back quite strongly. And in this environment, I feel this is good for value unlocking, because the premium for growth what markets were paying the last 3, 5 years when growth was very scarce should probably go away. And in the Indian context, what I have observed is that while the Ps are high, the sectors which are enjoying the high Ps, they have not delivered profit growth which is significant. Because in India, we actually don't have, in the listed space at least, any genuine technology companies. And if you look at the growth of the consumer space, which is very expensive, the profit growth has been quite disappointing. I feel that X of the consumer space, by and large, the Indian markets are reasonably, attractively valued, and there are quite a few opportunities. There is one space specifically I would like to point out, and there I have a slight difference of opinion from what Nilesh said. Nilesh said that in power we are in surplus. I think yes, that is true probably today, but it may not remain like that in some days to come. And you can go and check the merchant power rates. Where what was it last year and where is it now? It's crossed 5 rupees already. So I think for last 10 years, India has not invested in any new thermal capacity. I think we could possibly be looking at a very tight demand supply situation in the power sector. While solar is good, it will not meet our daily peak load conditions, which is in the evening between 5 to 9. I think that space offers growth, and it is extremely cheap because of significant, to my mind, misunderstanding and wrong notions about this sector. I would also say that the corporate banks which were suffering from NPAs, that NPA cycle is genuinely ended. I think they offer good value. The capex should revive because profit growth is coming back. And when corporates make money, they will invest at some point of time. And I think the initiatives that the government has taken around the PLI scheme are extremely timely and are likely to be very effective in supporting not just manufacturing for India, but also manufacturing for exports. I think corporate banks, capex, utilities, these are some of those sectors I would be specifically positive.
Right. So, one question, Prashant, and this we keep getting asked often is, there has been a fair amount of disbelief on markets because on one side, we see things around us not doing that great, especially for small, medium enterprises. But at the same time, we see markets at all-time highs. Now, for an average investor, how does he, view this dichotomy? Is it a dichotomy, or as you said, and Nilesh also pointed out that we are at an inflection point as far as profit growth is concerned. So how does an investor come to terms with this dichotomy?
Ashish, I think I'm glad you asked this question, and because my view has been very consistent. Even at the bottom, I was saying the same, that COVID will pass, but so will this opportunity. And at bottom, India's market cap to GDP had fallen below 50%. And the pain was short-lived, that everyone knew. And the fall in cost of capital was also a result of that, which improved the outlook for equities. So I think there are four ways to feel more comfortable with this market. One, look at the 10-year returns. You showed on your chart, 10-year returns are barely in double digits. Now, that is not a sign of any excess. It has barely kept pace with the nominal GDP growth over 10 and 15 years. I think we can rest assured that maybe the markets have bounced in the last 1 year, but over 10 years, returns are just about 11%, which is not excessive, number one. Number two, if you look at the gap between the bond yields and the earnings yield, it is below last 10 years average. 10-year average is 1.8%. Today, the gap is 1.6%. And earnings are likely to grow extremely fast. So earnings yield could actually increase much faster than what people are building in right now. 1 year down the line, the same earnings yield would be 15-20% higher because of growth. India's market cap to GDP is also near longer term averages. And I think if you look at the dividend yields on many sectors, they are, virtually half to two-thirds of the bond yield is being delivered to you by way of dividend yield. In fact, in utilities, it's a very unique situation. The dividend yields are higher than the cost of borrowing of these companies. I think these are markets, don't focus on the last 1 year returns, because if you look at last 2 years, it is still okay, because you can't look at the market from the bottom. I think that is what is causing this confusion. So I would encourage people to look slightly longer term and look at the aggregate valuation ratios to feel more.
Right. Thanks. Should we be worried about the recent spike in the COVID cases? Will it have do you worry that it will have an impact on corporate profits?
See, the point what you mentioned, Ashish, the small, medium enterprises are feeling the pain. But so I have said this earlier, that COVID was more of a social problem and less of an economic problem. Because the well-off households have not been impacted. The larger companies have actually benefited, because the small, medium enterprises have not been able to reach out to the consumer or to deliver. And that is one of the reasons why stock markets have done better. While that pain remains in certain segments of the society, I am not too worried. Coming to this question on COVID, see, India is now, I think, vaccinating roughly 3 million doses a day, which means in 2 months' time, you should have done how much? About 15-20 crores would be vaccinated, and 8-10 have already done. The moment you have vaccinated 20-30% of the population, and in the next 2 months you will cover probably half, I think the incidence of this should get over. And most people agree that the impact of this wave is likely to be a fraction of the last wave. equities are a long-term asset class, but very hard to forecast in the short term. I would agree with what Nilesh earlier suggested that if there are corrections induced by this, we should think long-term and take advantage of.
Great, great. Thanks, Prashant. I think that was a fairly, simple way of looking at things. Coming now to an asset class which Indians absolutely love, which is real estate. And we have, our CEO of the Motilal Oswal Real Estate Division with us, Sharad Mittal. Sharad, you've been investing last 8 years, and you've invested in residential, and you've invested some money in commercial as well. Do you really see green shoots in residential real estate? Are you as optimistic as a lot of people who are buying houses are?
Yeah, thanks, Ashish. It's good to be here with all these stalwarts from the our capital markets. See, what we need to see what are the reasons because of which we are seeing this turnaround. I would still call it green shoots rather than saying it's a full-scale recovery. We probably need to sustain it for minimum 9 to 12 months more, this kind of sale, to really say that we are going to turn a corner. 4 things have happened together, and all of it happened during COVID, which have showing these kind of green shoots for the sector. And it's very welcome. It's been a lost decade for residential real estate, and it was long due. The 4 reasons are, first and foremost, is the 15-year low mortgage rates. Before the lockdown happened in March, the mortgage rates used to be between 8.25 to 8.5. They are firmly at 6.75. And in fact, I see a lot of banks really going aggressive in accumulating mortgage loans. I would put this reason as a 50% weightage for, especially in mid-income housing. Maybe it does not matter so much in Bombay luxury and Delhi luxury. The mid-income is 5 to 7,000 rupees a square feet. That is one reason. Second is price stagnation. Property prices on absolute basis are same as March 2013. March 2013 is when we saw the peak property prices in India. It's been 8 years. And if I look on inflation adjusted, we are probably looking at 2006-07 prices, and city like Bombay earlier than that. So from that perspective, there is a sense in the home buyers that probably it's a good time. During this period of 2012 to 20, the income levels have gone up by 78 to 80% in absolute terms. So the key challenge of affordability, you remember we used to talk about 2013, 14, 15, why property prices are not affordable, why don't they crash? The fact is that except some parts of Delhi and Bombay, affordability is not the biggest challenge. Biggest challenge is the trust deficit with the developer. So I think because of prices remaining stagnated, it's become affordable. There is also a sense of a deal making with home buyers. They believe they can get a good deal. This could be a good time to buy a house. And I'm so happy to see that the developers are not acting funny and not disappointing the home buyers. If a home buyer is coming, they're ensuring the sales takes place. They're not increasing prices. They want to clear the inventory. That's the second reason is what I see. Third is work from home. And this second wave, I've actually, and there are 2 things which are happening because of work from home. One is the practical need of owning a larger home, or a house which can be customized to your own requirement. We know so many of our colleagues, so many of our friends, where both husband and wife is working, or 1 or 2 kids is there, everybody is operating out of the house. Most of the IT companies haven't got their employees back at work. You need a larger house. You need a house where you can have your things your own way. So that's a practical need because of work from home. With the second wave, and we have seen globally, there are 3 and 4th wave also, 3rd and 4th wave also hitting. I think this is also playing some part to it. The other part of work from home, and this is something that I have spoken around my community, and I'm talking about financially savvy people. I'm not talking about people who don't understand the gap between rental versus mortgage rates and that whole debate. At the start of the lockdown, which say April, May, when I used to speak around in my friends and family, they used to feel that having your own house gives you a sense of security. Maybe the uncertainties were so high during that time. That is also playing on people's mind. The 4th reason, and that's something I'm seeing specifically in Mumbai real estate, is the lack of investing opportunities. So of course, equities have done exceedingly well. But what we are seeing here is that equities are at all-time high. Gold a month back was all-time high. Debt returns are at 15, 17, 14, 15-year low. Some bit of reallocation of money is happening from some of those asset classes, specifically in the luxury sector. So I think these four things have come in together. But going forward, whether it will continue or not, structurally, one thing is clear, that the business is getting cleaner. Business is getting consolidated towards larger developer, and larger doesn't mean just the large branded developers. Larger means guys who have been able to manage their balance sheet well. And this is a slow process. Real estate is a very fragmented asset class. There is nothing going to happen overnight. Actually, journey started when the RERA came in May 2017. So we are already 4 years into it, maybe a couple of more years. As far as sale momentum is concerned, like I said, interest rate is one critical factor which needs to sustain for this kind of sales to happen.
Right. So Sharad, what you're basically saying is if any of our clients want to buy a house, this is the good time. Developers are willing to cut deals. What about commercial? I mean, we've seen, this pandemic really, hurting a lot of commercial real estate. We've seen corporates negotiating rents. We've seen a lot of large tech companies who mandated work from home and also vacated some premises. So how do you see the commercial sector playing out, especially with the listing of some of the big REITs, which has happened?
Just to answer your first question, whether people should buy the houses or not, I'm not making a case for a price rise. And one of the benchmark in our industry which is followed is inventory overhang. How many months of inventory is there unsold? And it has to be seen from a demand supply perspective, not from overall gut and seeing that there is a momentum. Delhi and Bombay probably have an inventory overhang of between 3 to 5 years. It's only in the IT cities which are between 15 to 20 months. And it has been continuously coming down over a period of last 4 years. At the peak of the real estate cycle, the previous peak of real estate cycle of 2007-8, the inventory overhang was between 10 to 12 months. That is a period in which the buyer and seller has an equilibrium. Both of them, it's not just one-sided trade. And I think over a period of next 2 years in IT cities, we should get closer to it. And that would be the time wherein you would see price escalation. But I don't think so prices are going below this. If that is, but I don't think luxury market, there is any scope of price rise for a couple of more years. Coming to commercial, see, commercial had a dream run till the COVID hit us in March 20. Just to put some numbers in the perspective, the overall grade A office space in India is 600 million square feet. 2017, 18, 19, and 20, 4 years in a row, we had record absorption. In fact, 2020 March, just before the lockdown took place, the absorption, net absorption was close to 40 million square feet, which is a very large number. Now, the challenge here is that IT companies, which occupies IT or IT-enabled companies, which occupies little over 60% of these office spaces, have not made up their mind. See, the challenge here the way I look at it is that for a mid-sized business or a financial services company or an NBFC operating their branches will be quick to make decisions, and whether to vacate or continue, they'll be able to take those decisions quickly. My sense or interacting with some of these large occupiers is as follows. I think they are going through a 4-stage process. First stage is wherein they say that we are not going to take any fresh spaces which we had planned. The second stage is when they say that we are going to renegotiate the contracted escalations which will come. Third stage is when they will say that we are going to renegotiate our existing rental. And stage 4 is that, look, this is looking absolutely fine. Let's start reducing the office space. What people want to see is the stage 4's result quickly. Most of these IT occupiers are still in stage 2. They have not even moved to stage 3. This also is to do with the fact that the IT companies have done exceedingly well. What I hear from you and rest of that IT companies over a period of the last 1 year has done well. So they are not going to rush into making a decision. And that's where my concern is, that on one hand, not only REITs, but rest of the market believes that we are back to kind of a normal scenario. I think work from home and capacity moving to home is still to be played out. Let me also tell you, some of the guidance that IT companies had given would have we would have collapsed the commercial real estate, which was closer to 30 to 50% capacity moving to home. Even if 10 to 15% capacity moves to home, we are talking about 60 to 90 million square feet of ready office getting vacated. In addition to that, there is 200 million square feet of offices which are already under the construction. So I think if it is 15% also, we could have challenges coming in. So I'll probably suggest that one should wait for 6 to 9 months. But one thing is absolutely clear for investors of any kind, whether large institutional investors, HNI or retail investor, REIT is the way to do investing in commercial or any rental yielding asset.
Right. Thanks, Sharad. That was pretty interesting to know. Moving on to Siva, I mean, a lot of fixed income investors, Siva, and very confused because, there has been a credit shock literally last year in portfolios. And, people want high safety, but high safety is coming with very low returns. People are worried that we are at an all-time low interest rates and interest rates might go up and there could be an MTM impact on the portfolio. And fixed income is the largest allocation in financial portfolios. So how should an investor look to invest in fixed income, Shiva?
Thanks, Ashish. It's very, very easy to sort of still think in terms of credit crisis, but ILFS now happened nearly 3 years ago. I mean, it's very difficult to remember. Think about that. August, September 2018 was now nearly 3 years ago. And so the context in which we framed our thoughts for the last few years has been this whole context of, if you go back from that period, from 2018 to 2020, we started off with very tight monetary policy, and then ILFS happened. Remember that the lead up to this, we had demonetization, GST. So there was a fair amount of economic uncertainty, I would say. And since then, so over the last 3 years, we've really seen the worst of that cycle. What we see now over the last few quarters is a lot of these things turn around. We have monetary policy, which has done a complete 180, from going from tight liquidity to easy liquidity, very low interest rates. And as all your previous speakers have been talking about, there has been a consolidation of businesses, which means that relatively larger organized businesses have significantly outperformed during this pandemic. And why that matters is because the larger businesses in every industry and sector are typically your AAA, AA corporates who then come and borrow in the corporate bond market. Matters for us. So both from a macro perspective, which is to say that we are seeing some kind of growth recovery, we are seeing policy firmly on the side of growth, fiscal push for high deficit spending, capex, infra, production-linked incentives, you name it. And and there's been an alphabet soup of programs from the RBI like TLTROs and moratoriums and restructurings and so on and so forth. The reality is, I think, that we are seeing a turnaround in the credit environment and the macro environment for fixed income. But when you look at the turnaround on the credit side, while it's positive, it's not the same on the rate side. So obviously, interest rates have started to move up. And in fact, as growth becomes more entrenched, even the RBI will have to revisit its interest rate policy. In the latest policy statement, the RBI has made the observation that they want to keep monetary stance accommodative while there is still uncertainty on growth. That is to say, the moment they get confident about growth coming back, they will want to normalize interest rates. And all the previous speakers have said that, I think broadly the expectation is over the next few quarters that we should start seeing growth getting normalized. And therefore, interest rates should start getting normalized. Rates are headed up in a sense. So if rates are headed up, one of the easy trades over the last 3 years, so one of the difficult trades over the last 3 years was credit, but one of the easy trades over the last 3 years was to just go out and buy short-term AAA PSU bonds, and that category saw huge amounts of inflows. We saw yields on these bonds come down from 8.5, 8.75 levels all the way down closer to 4%. Those fantastic capital gains to be made. Yields were high to start with. So the last 3 years, people made tremendous money on those assets. But when the rates start to go up, you're starting with a low yield and potentially staring at capital losses if there is a very sharp up move in rates. So I think there is a shift. We need to be aware of that. And certainly when the underperforming sector going forward is likely to be the sector which has outperformed the most, which is your AAA short-term bonds, let's say 3 to 5 year AAA bonds, which have done really well, probably will also take a lot of pain. But it is not all bad news from a fixed income perspective. Rising yields is very, very important to preserve value. The starting point for a fixed income investor is, can I beat inflation? And with inflation projected to be about 5% for the last year, with almost all kind of, wherever we would like to put money, everything was 3-4% kind of yielding assets. Finally, suddenly we are looking at 5-year bonds, for example, moving above 6% mark, 10-year AAA bonds at above 7%, and of course your non-AAA paper significantly above that. So I think now we are finally reaching a stage where fixed income funds are, to start with itself, I think, having yields which are above inflation rate. And more importantly, when you look at, especially at the shorter end of the yield curve, there is this brilliant opportunity for what I call reinvestment. So in bond markets, I think we think that rising rates is always bad news, but it isn't. For example, if you're buying a 3-month commercial paper or a 1-year commercial paper, and the interest rate hike happens, let's say over the next 3 to 12 months, as your bond matures or your CP matures, you're redeploying at higher yields than before. So in a rising interest rate environment, these kind of short duration bonds actually outperform very, very nicely. Upfront, the yield will be low, but that's all right, because you're not investing for 3 months, you're investing there for 3 years. So as long as you are able to manage this rate hike cycle, I think there is this huge opportunity here. And this trade-off between duration and reinvestment is something we must keep in mind. So when you have short duration bonds, the cash flow comes to you early and you redeploy at higher yields. But if you have longer duration bonds, that comes with higher mark-to-market risk. Also, your reinvestment is delayed because your cash flows are maybe 3 or 5 years away. So this trade-off between, I think, bond duration, cash flows, therefore, and reinvestment, I think is going to be super critical in the current environment. But like I said, more opportunities than risks, I think, from a fixed income perspective. And finally, the ability for us to see significantly positive after inflation rates of return. I think that's the starting point for any fixed income investor.
So Siva, just to explain to our investors in a simple manner, let's say if I have a 3-year view, right? And obviously fixed income is an asset class where I'm looking to preserve my capital, but at the same time, like you said, try and beat inflation marginally. How should one go about allocating this portfolio today?
Right. So a pure 3-year bond, if you were to buy a 3-year AAA bond, will barely beat inflation. Will probably underperform inflation. So in that sense, that's probably one piece which I will actually not buy. If I were to buy today a portfolio, I would either buy a very short bond. I'm upfront sure that I'm going to be below inflation, but I know that when RBI starts to increase interest rates, I'll be able to redeploy at higher yields. So therefore, my total return over 3 years or 5 years is actually going to be better off than by buying a door-to-door 3-year bond. The alternate strategy you could do is to actually branch out. Why look at the 3-year AAA? For example, if you buy a 10-year AAA at this point of time, you're getting well above 7%. And the spread between, let's say, 2-year, 3-year bonds and 10-year bonds is somewhere in the range of 2% per annum. So let's say over the next 3 years, you make 2% per annum higher yield, right? So that means in 3 years' time, I have now made 6 percentage points in excess income. That takes into account something like a 75 to 100 basis points rise in yields. That means even if interest rates, even if yields on long-term bonds, let's say, if I buy a 10-year bond today, it's going to be 7-year bond 3 years from now. Even if the yield on that 7-year bond were to rise by 75 to 100 basis points, up to 1 percentage point, you're actually better off buying a 10-year bond than to buy a 3-year bond. The ability for us today to, for example, buy a 10-year bond, and after inflation, after LTCG, long-term capital gains tax, you're actually going to significantly outperform inflation, significantly outperform other tax-free alternatives. I think that's the way to go. So there are very, very interesting opportunities right now in fixed income markets. I think and these are relatively, like I said, insulated even against the rise in yields from here on. So there are, I think the way to look at debt funds is don't do the same thing that you did over the last years, which has worked. But I think you need to look a little bit outside that if you really want to make money.
Thanks, Shiva. So what I hear you saying is that, investors should, if they have a 3-year plus view, they should look at a bit of both in their portfolio, kind of a barbell strategy.
That's right. So we've been calling, absolutely. You're absolutely right. It's a barbell strategy, which is to say you hold more cash or cash-like short-term assets and
the short-term funds or low duration funds, which keep getting repriced higher as short-term rates go up. and some bit could still be in 10-year kind of bond funds or 8-year corporate bond funds, so that after 3-4 years, right, these the maturities and roll down funds, so the maturity of these funds would itself come off. So that would give a very good combination.
That's right. So your overall duration of your portfolio would still be, let's say, 2 years or 3 years or whatever you are comfortable with, but actually we are not buying 2-year, 3-year paper at all. We are rather buying both ends of the curve. And it's important that you use one word which is very important, which is roll down. In a roll down strategy, the duration keeps coming down, so that if you start with the duration of, let's say, 6 or 7 years today, in 3 years time, that's probably 4 years or less, and 5 years time, that's 3 years or thereabouts. So it's important because in a rising interest rate environment, you don't necessarily want to maintain a long duration stance throughout your holding period. So ideally, a roll down strategy reduces that risk as you go forward.
Right. Thanks, Shiva. I'm just going to go back to Nilesh Bhai. Nilesh Bhai, you also, at Kotak have launched recently an international fund, and you have one of the larger gold funds as well. I have 2 questions actually, and I'm going to ask the second question to all the panelists. The first one is, last decade has been phenomenal for NASDAQ and US versus not just India, but emerging markets. Next 10 years, which asset class do you think will probably outperform? And does gold still have a place in investor portfolios?
So Ashish bhai, in my opinion, investors should diversify into offshore assets. It gives them diversification against India risk. We are bullish about long-term India growth story, but there are many businesses which are available in outside world and which are not available in India. Depending upon your risk profile and investment objective, diversification into global funds will help you reduce the risk and maximize or optimize the return. Now, one should be careful about investing into offshore fund. You want to invest on a diversified basis rather than concentrated basis. You want to invest, let's say, in large countries like US or China rather than a small country like Zimbabwe. Third, you want to invest in funds which are regulated by a regulator rather than an unregulated entity. We have seen very recently in a cryptocurrency called stablecoin, the issuing authority said that I will keep dollars equivalent of stablecoins issued to you. So stablecoin price will always remain at $1. And later on it raised hands saying that, sorry, I don't have dollars. So it is extremely important that when you invest in offshore assets, it is in a regulated entity, it is on a diversified basis, and that will help you optimize the risk-adjusted return. Fortunately, today in Indian mutual fund industry, you have choice of country funds like US, China. You have choice of sector funds across the globe like technology, life science, and so on and so forth. And many of these funds provide opportunity which probably does not exist in India. From an allocation to gold point of view, generally we have seen that when interest rates are low and liquidity is high, gold prices do get supported. In 2008 to 2011 period, gold had moved from $750 post subprime crisis to almost $1,900 by 2011. Thereafter, gold prices corrected, remained stagnated for a while. And in recent times, post-crisis, from $1,450, gold did move to $2,000 and now have corrected back to $1,700. We think gold does provide you protection against inflation as it is provided over the years. And in today's environment of low interest rates and high liquidity, gold prices should deliver good return. One caveat though, when you are investing in gold, do remember that India has 10% import duty. So what is worth $100 of gold in, let's say, Dubai is worth $110 in India from a cost point of view. Tomorrow, if import duty becomes zero, you will see 10% reduction in your rupee value of gold on an immediate basis. So subject to the risk of import duty becoming normalized, gold as an asset class, there should be some allocation.
Right. So, if I were to ask you, Nilesh, by two asset classes, one for wealth creation and one for safety and protection, which would be the two?
So from a wealth creation point of view, there is no substitute to equity. As one of my banker friend always used to say, show me a person who has become billionaire by investing in bank deposit. A bank deposit is for safety. For growth, you have no option but to invest in equity as an asset class. And today you have choice of equity, local versus global, actively managed equity versus passively managed equity, equity which is listed versus equity which is unlisted. So depending upon your risk profile, depending upon your investment objective, you can pick up across the range of equities for wealth creation.
Right. Thanks, Nilesh bhai. I mean, I think we can now go into the Q&A. Nitin, we've had a very, very interesting discussion. I'm just reading out from the Q&A box. I think maybe I'll ask this question to Prashant. Prashant, there is a question from one of our investors who's asking views on underperformance of two-wheelers in spite of rising incomes in rural India. And the other fear he has is similar to the one we spoke. What if the anticipated elevated earnings growth do not materialize? I think that's for markets as a whole.
On two-wheelers, my view has been very clear for, I think, almost maybe 5-10 years, I would say. That India has about 25 crore households and we are selling about, I think, 2 crore two-wheelers a year. And the penetration rate of two-wheelers in India on a household basis is about 70%. Even at the same rate, and the scrappage is much low. So even at the same rate of sales, the penetration will continue to increase. I think that is what you see when you look at these companies last few years. The growth has been extremely low. And that is why these stocks have generally derated. The second thing is that, as I said, COVID and lockdown has been a greater social problem and less of a economy-wide problem. The buyer of the two-wheeler is more from the informal sector, the blue-collar employee. I think that will have some near-term impact. The third risk that what people need to now price in is that three-wheelers will move to electric pretty fast. I think cost parity has been reached. And I think two-wheelers also, the scooters first, will start moving to electric in the next couple of years. And at such points of time, I mean, pools of profits of incumbents can get disrupted. So I would say I'm not too surprised by what is happening in the two-wheeler space. I think as far as profit growth is concerned, see, the biggest change in profit growth is coming from the banks, because the banks balance sheet of these 2-3 large banks who were down with NPAs was almost 60-70 lakh crores. Now 1% swing is 60-70,000 crores. I think by and large profit growth is reasonably secure, I would say. And yes, in the past, our expectations have been delayed because the IBC resolution took 3 years, where ideally it should have taken a year or so. But I don't think it is at risk. A significant part of the profit growth will come from the sharp uptick in commodity prices. And there it is hard to say how sustainable it is. But generally, when you are at 2% profits to GDP, I think it makes sense to be optimistic on profit.
Right. I think you've also answered the second question I was going to address, which is somebody has asked the future of PSU banks, Mr. Rupesh from Mumbai. And you did mention that you feel they've taken all the pain and some of the banks are looking pretty well poised for profits, coming through.
Yeah, Ashish, if you have a minute, I will like to maybe address on PSUs in general, because I think there are quite a few misconceptions in the market. People reach conclusions without looking at the data. That is the sad part. If you look at the profit growth of PSUs versus private, then you will be surprised to note that PSUs have actually done better than the private companies in last 5 years in terms of profit growth. In our yearbook, there is a very clear slide. It is driven by third-party data. PSUs have underperformed not because of lagging in profits, but they have underperformed because I think the government followed a strategy of divestments focusing around ETFs, which I thought was quite damaging for the market caps of these companies. Now that there is a complete U-turn, you are going out, you are going away from selling in the market to selling to strategic buyers, and hopefully that will result in open offers. I think the real value of PSUs, I think current year should be a decisive year as to what is the real value, because strategic buyer in a auction situation, the real pricing should come out. So I would encourage people to make any decisions or views based on the changing environment. Thank you.
Thanks, Prashant. Interesting. I think there's one question from Mr. Sanjay Kulkarni. Maybe I can address this to Nilesh Bhai, that March is the first month, Nilesh Bhai, after a long time where there is a positive inflow. I think they're talking about equity mutual funds. So, the question is, do you see this trend continuing? If so, then, do you see domestic institutions now, buying more going forward?
So Sanjay bhai, never ask a barber whether you require haircut or not. A mutual fund CEO, if you ask whether equity flows will continue or not, is more likely to say yes. But on a serious note, Sanjay bhai, we think if you go by the past experience, whenever there is a sharp rally in market, towards the fag end of the rally, when investors feel it is becoming expensive, they do the profit booking. And many people also have the habit of getting out early. So I still meet investors who moved out of Nifty at 10,000 level or 11,000 level. And I'm sure Ashish, Nitin, you would have also faced such number of clients. Now, when the first correction comes, all the waiting cash start getting invested. We believe in the mutual fund, there are two components. One is SIP, another is lump sum. All throughout pandemic, SIP numbers kept on going up, albeit SIP value fluctuated and came down as many people paused or reduced their SIP amount. We believe now with economic recovery coming into play, SIP flow should continue to grow. The second one was lump sum. With correction, many people who had taken profit out or who had redeemed early or who are waiting to invest are also doing systematic transfer plan or lump sum investment in mutual fund. So from a gross flow point of view, SIP as well as lump sum, we are seeing positive flows across equity funds. The second thing is the redemption. Many people redeemed during pandemic because they needed money. Some people redeemed because they were doing profit booking. Some people redeemed because they thought markets have run up too much. Now, redemption pressure has come down, and hence you are suddenly seeing that in the month of March, equity mutual funds got about 9,000 crore worth of inflows. My feeling is that this trend will sustain going forward. We should see good positive flows in equity mutual funds in FY22. Year to date in April, and it's just 8 days, but the flows have been positive.
Right. Thanks. I think next question is for Sharad. The Mr. Siva from Bangalore is asking whether this is a good time to invest in REIT, although you did cover in detail the commercial sector. But what will be the growth rate in, let's say, the coming 2-3 years?
Like Ashish, what I mentioned is that the investors should first understand what exactly is the REIT. Because if you really look back and say there could be some bit of education that can happen from our side, the first REIT globally happened in US in 1962. So we are like 40-50 years behind. The whole cycle has played out. There have been a lot of learnings. REIT is as an asset class is going to grow over a period of time. So there is a short-term blip of seeing how the commercial cycle plays out, where I would like to wait for 9-12 more months to see what's the real impact of work from home. But REIT is not only about commercial assets. REIT is about any asset class which can generate rental yields. Just on a lighter note, in US, the best performing REITs are prison REITs. Large part of the prisons are REITed there. So government doesn't want to own anything. We probably will reach there after 30, 40 years. But as a concept, it's an asset class where you can have fractional ownership as low as 50,000, which I understand SEBI is looking to bring it further down to 25,000, can be sold on a click of a button just like equity, and can give slightly debt plus kind of return in a diversified portfolio which is managed by professional fund managers. So this is an asset class should become part of a investor's portfolio. My request only is that just wait for 6-9 more months to see the real impact of this disruption that COVID or the lockdown is creating.
Right. Thanks, Sharad. Shiva, the question to you is, we discussed in detail what should be the portfolio strategy for an investor, but there is a specific question. Should investors be looking at dynamic bond funds and duration funds at this point in time? You do manage a fairly active and large dynamic bond fund.
I am not sure if I want to get into particular funds, but in the category of dynamic bond funds and other longer duration funds, there's a wide variety of different strategies. So there are some funds which do things like roll downs, which I'm very confident about at this stage, given our view on the market. And there are others which are, of course, running fairly long duration strategies. So I think it's very, very difficult to give a category view because it's such a diverse category in that space. But I would be very happy to find funds which are relatively, for me, the better buy would be a roll down in that space rather than a pure long duration strategy. But then that completely depends also on your portfolio as an investor, where all you have invested. And I'm sure the Motilal Oswal team here is around, and they'll be able to guide you better than I can. Looking at a fairly diverse category.
Right. So just to sum up, I think dynamic bond funds is a fairly diverse category and different funds have different philosophies. So I think before you invest, it's important to understand the specific fund that you're going to invest in. And if you need any help, we are always there. Prashant, there is a specific question to you. The question is more macro in nature. This is Sushmit from Chennai. He's asking, with the debt to GDP of many countries like US and China bloating, is that a threat to global recovery?
I think that's a very interesting question, but very difficult to answer. And I think the biggest risk or the biggest question that all of us are faced with is the extremely low interest rates that we are experiencing the world over, and the very high levels of indebtedness across, especially the developed world. What happens if 10-year yields in US move to 3%? I think that is the biggest risk, and I don't have a clear answer, though I am cognizant of the risk. And that's why I would be a little less sanguine on global equities. And again, Ashish, as you presented in your sheet, the last 10 years, the returns of the NASDAQ has been extremely strong. That I think has been partly driven by the very low cost of capital. Because the moment you have virtually 0 or 1 or 2% cost of capital and you have a assumed growing income stream into the long term, you can virtually justify any valuation. I think it's a very pertinent question, but I don't think I have the right answer. Their views would vary from person to person.
And the other question, Prashant, is active versus passive. A lot of people want to know, should they go the ETF way? Should they invest in active funds? Our views, but I just want to know your view, and maybe Nilesh Bhai can also come in here. Because both of you have active as well as passive funds in your stable.
The simple answer to that is there is space for both. There is room for both. And the real answer is that if actives outperform, if they add value, then they will continue to find favor with the investors. And if they do not, then of course they will lose market share. I'm a little more optimistic on outperformance of at least a fair number of funds. The last 3 years, the index returns were driven by basically 5 stocks. If you look at 2018, 19, 20 calendar years, the top 5, the best performing the 5 top contributors accounted for 80 to 140% of the returns of Nifty in each of these years. Now that's a very challenging environment for an active manager to beat, because active funds typically have 30, 40, 50 stocks. As markets become more broad-based, I think some active managers will be able to beat. The second issue here is what again was discussed earlier. The last 10 years Nifty returns have been around 11% CAGR. And we all know mutual funds have roughly 2% expense. 2 on 11 is almost 18% hurdle rate. So I think this was a period, I would argue, of low equity returns in which the expenses or the costs themselves became a significant hurdle. As overall returns improve, I think the drag of the expenses should reduce. But as I said, these are views. And as Nilesh said, don't ask a barber if you need a haircut. So similarly, don't ask an active manager the future of funds, but maybe Nilesh could add something.
Nilesh bhai, your thoughts?
No, Prashant bhai correctly summarized. As investor, as advisor, your dharma is to invest in those active funds which outperform benchmark index. As Prashant bhai mentioned, as fund manager, our job is to outperform benchmark index. But I would like to add some of the constraints which we are facing, which you need to evaluate. Today, indexes have more than 10% weightage in HDFC Bank and Reliance Industries Limited. But funds exposure to this stock is kept at 10%. When this two stock does well, and generally they do well, funds underperform for no rhyme or reason, for no fault of fund manager. Number 2, most equity funds are open-ended and they provide daily redemptions. Index does not carry any cash for daily redemption. And over a longer period of time, equity outperforms cash, creating drag for fund manager. Number 3, globally when index constituents change, they are done net of impact cost. In India, index changes constituents at the closing prices. Now, any person will be able to figure out that there is always an impact cost when you have to buy or sell a stock. Large, small, but there is impact cost, which index does not take into account. Now, if you look at most index funds, because of impact cost, because of churn, because of various other reasons, they actually underperform index by 1 percentage point on an average. Now, when you compare active funds with that, you will realize that most active funds are still adding value to customer. So I will advise customers and distributors to follow their dharma, pick up those funds which are generating alpha, which are adding value to your portfolio. But as a fund manager, I will request that do keep in mind the constraints under which fund manager is operating while evaluating his performance.
Right. Thanks, Nilesh bhai. I mean, either you can answer it, Nilesh bhai, and then maybe I can hand it over to Prashant as well. There is a investor from Kuala Lumpur, Mr. Rajkumar Shah. I think his question is, he's asking the attractiveness of India versus other emerging markets. I mean, what would your, let's say, pitch to an NRI be for India? I think you're on mute, Nilesh bhai.
Can Prashant bhai start? I have a azan sound coming, so it will create disturbance.
Sure. So, Prashant, you have people investing from overseas in your funds. So, generally, what should be the pitch at this point in time for an NRI? Why should he come to India?
I think India has several advantages compared to most other emerging markets. One, it's a very large economy and a very diverse economy. If you look at the index weightages or composition across most EMs, it is heavily concentrated or biased towards one or two sectors. So to that extent, Indian market, Indian economy offers you an extremely large choice. I think the reforms momentum in India is one of the best that I have personally seen in last 30 years. It compares only to early 90s, what we were seeing. And I think probably COVID has been, and the fallout of that has been a trigger for that. The focus of the government on Make in India, on infrastructure, and on the massive opportunity that India has as China is losing competitiveness in manufacturing. Manufacturing is shifting away from China. And I think India has a unique advantage there to gain a large share of that compared to its other Asian peers. One, of course, costs are comparable or lower, but I think the trump card that India has is the very large domestic market. Up till now, I mean, to my mind, we did not leverage that effectively. And first time, we are beginning to use the size of the local demand to our advantage, and we are incentivizing production to be set up in this country. I think with the government firmly behind the businesses, and what is the PLI scheme that Ashish referred to in his opening remarks? It is it amounts to basically putting it is basically cash transfers to companies for producing more, and I have never seen that happen in India. So I think that gives you a glimpse as to how focused the government is on improving corporate profitability. For the first time in India, we are openly using the word privatization. Up till now, we used to say divestment, and we were very, worried about using the word privatization. But now you can see on the floor of the parliament, on TV channels, Prime Minister, Finance Minister are openly espousing the merits of privatization. I think, and as Nilesh said, if PSUs are given to private hands, it will be very positive for the companies, for all stakeholders. So I think these reforms are for real, and I think they will improve India's growth rates going forward, and that's why I think I'm quite optimistic on this country going forward.
Ashish, if I can add,
Sure, sir.
Rajkumarji, I just want to give you a story about Maruti Suzuki and Suzuki. Suzuki came to India in the 80s to establish Maruti. In those days, India was fairly backward. It went up and down, and it continued to remain in India to emerge as India's largest automobile company. 2003, it got listed on Indian stock exchanges, and today it remains one of India's largest automobile company. Maruti sells in India primarily. They do some export, but it's much less. Suzuki sells all over the world. Maruti, whatever profit it earns before taxes, it pays about 40% by way of royalty to Suzuki. Suzuki doesn't give one naya paisa to Maruti. And despite this, Maruti's market cap is roughly about $27 billion, whereas Suzuki, including more than 50% ownership in Maruti, is valued at about $22 billion in Japanese market. Investors have made more money investing in Maruti than in Suzuki. I don't remember correct data now, but at one point of time when I evaluated, Maruti stocks return between 2003 to I think 2018 in US dollar terms was higher than Suzuki, Honda, Nissan and Toyota put together. This is the potential of India. Here, one subsidiary company will become bigger than the parent. This is true for Suzuki and Maruti. One day this will become true, hopefully, for many other companies. This is the growth opportunity which India provides. We are a continent rather than a country, and the growth is rapidly increasing in India, courtesy all the steps we have taken in the past. This is the opportunity for investors. When you invested in China between 80s to 2020, you made tons of money. Same kind of investment opportunity will arise in India over next 10, 15, 20 years.
Right. Great, Nilesh bhai. I think that's a very, very optimistic note to end our conversation, although the questions keep flowing in. And, I wish, we could go on with this conversation because, I can see very, great minds on this panel. Most clients also must be wishing that we continue, but it's been 90 minutes. And I really, thank all of you for making time and being on this panel. Sharad, Shiva, Prashant, Nilesh bhai, all of you. It's been a really wonderful, conversation. I've really enjoyed the conversation. And before I go, I've got the 100th edition of the Alpha Strategist delivered at my home. But for most of you, it'll get delivered in your mailbox, given the current situation. But again, it's really we're very happy to have reached the century of the Alpha Strategist. And what better way to celebrate it than having some of the greatest minds of our industry take us through what they feel about different asset classes. So thank you very much, everyone who's watching, on the digital platform, on YouTube. It's really been a pleasure. Thank you, everyone. It's
Thank you.